essentially, when you're a TV reporter, you hear a variant on two things: shut up and keep talking. And the guy said, that's it. That's the title of the book: Shut Up and Keep Talking. And then you can call it Lessons on Life and Investing.
Which one was harder for you, the shut up part or the keep talking part?
Oh, no, the shut up part. I was rather famous for, say, stretching my time on the air. I always had a little more to say than I actually was allotted. But it was an amazing experience.
All right, welcome everybody to The Informed Investor. I'm Mark Ochner, and we are coming today from fun and sunny Las Vegas, where we are here for an industry event. And we have a very special guest today, Bob Pisani, the icon of financial media. It's fantastic to have you here today.
Mark, thank you very much. I'm a huge fan of Dimensional. David Booth's a dear friend of mine, and I'm happy to be here.
Well, I love it. And your career, 35 years?
35
CNBC.
years at CNBC. 1990. I was 35 when they hired me. I left last year at 70. So 70 years old, turned 70 last week. And so half of my life at CNBC.
Well, congratulations on an incredible career. And most of those years, the huge majority of them, you were actually on the floor of the New York Stock Exchange, senior markets correspondent.
Yes, in 1996, early 97, I became senior markets correspondent. I was the real estate reporter from 1990 to 96. My father was a very successful real estate developer in Philadelphia. He and I taught real estate development. At the Wharton School, we were lecturers / adjuncts, and we did a book on fundamentals of real estate development that Wiley published in 1989, April 89. That was the course curriculum. And by sheer dumb luck, CNBC went on the air April 89, the month the book came out. And one of my best friends got one of the first jobs at CNBC as a producer and said, "What are you doing?" And I said, "Well, I'm teaching," and blah, blah. And she said, "Well, we have this new network NBC has called CNBC, and it's the Consumer News and Business Channel. And we're kind of doing finance and stock stuff. And come on, it's the real estate, because you have the book out." And they had my father on as a guest, and then eventually they had me on, and I talked my way into the job as the real estate correspondent. And in 1996, 1997, we had a shiny new object out called the internet, and all of a sudden, we had started getting ratings. In 1995, the Netscape browser came out, and it was a huge hit. And it turns out there were a couple of things that happened. One was suddenly people could invest online. You could actually put an order in, like Schwab and places like that, rather than calling a broker, invest online. Secondly, the internet was a hot idea, but it was hard to do a direct play. Netscape was the sort of first direct play. It was a browser, and the IPO was I think August 95 was a huge success. And the third thing that happened was they had a marketplace, a medium to talk about it. CNBC was there, the stock market channel. The ticker could have made us. And so that confluence of events happened. All of a sudden, boom, we got ratings. Just big ratings. And from about 95 to 2000, we were sort of the hottest things on television. It was quite remarkable. We started in 1989. I started in the summer of 1990. We had no ratings, and you couldn't get arrested. But by the end of it, by 2000, 10 years later, we were the hottest things on television. And I tell everyone, I hope there is some moment in your career when the wind is at your back and everything is going right, and you just really love coming to work because it's a joy. Not you say you do, but you really love it. That's what it was like at CNBC in the 1990s. It's the greatest 10 years of my life. I had so much fun, and 35 years, I had so much fun, I stayed. Well, I never left. Yeah. And I can't say enough about CNBC. It's just such a wonderful organization.
Well, and you, I'll say, retired from CNBC last year. And then you wrote a book. Speaking of, we'll come back to that here in a little bit. About 3-4 years ago, you wrote a book.
Yep.
Right. Shut Up and Keep Talking.
Shut Up and Keep Talking. And I wanted to summarize my career. Like 35 years is very strange. Most people don't stay in a job 35 years. But I had so much fun. I never changed. I never left. I was essentially the markets correspondent for 30 years. And I went to the publisher, Harriman House, and I said, they said, "We want to buy this book, but we don't want you to write a straight financial history. We want you to tell stories about people you met on the floor and use that as a springboard to talk about finance," which was fine with me. And I said, they said, "We need a title." I said, "Well, I want to call it Lessons on Life and Investing from the Floor of the New York Stock Exchange." And he said, "That's not a title. That's a subtitle. I need a title. So tell me, you're on the floor, right? All day long." I said, "Yeah, 30 years. Okay. You're waiting to go on the air. you have, how do they talk to you? I said, well, you have what's called an IFB. It's connected in your ear, and you have a microphone. They're wireless. Oh, what do they say? They say, Bob, hi, Don, producer, Carl is tossing to you in 3 minutes. You're going to toss back to David Faber. And you have 4 minutes or 5 minutes, however long you have. You do this several times a day. And good to see you. And you talk. And at the end of this, you hear one of two things. You hear the word rap. Rap means shut up. Or you will hear the word stretch. Stretch means keep talking. So essentially, when you're a TV reporter, you hear a variant on two things, shut up and keep talking. And the guy said, that's it. That's the title of the book, shut up and keep talking. And then you can call it Lessons on Life and Investing.
Which one was harder for you, the shut up part or the keep talking part?
Oh, no, the shut up part. I was rather famous for, say, stretching my time on the air. I always had a little more to say than I actually was allotted. But it was an amazing experience.
All right, let's go back to then what you did for those 28 years when you're on the floor there. I think one of the things you did so well is really a skilled storyteller. How were you approaching that mentally, thinking, hey, I've got this audience out here. How do I take some of these complex items, all this data, and make it something that's digestible for the listeners?
The thing you have to always be in mind is who you're talking to. So the problem with television is you're staring into this black hole of a camera. Who's on the other end? And very early on, I decided to talk to a very specific audience. So when I was the real estate correspondent, I created someone that was a viewer. It wasn't real. It was a woman in Minneapolis. She was 55 years old. She had two sons, a 23-year-old and a 27-year-old, and the 27-year-old wanted to buy a house. And so as a real estate reporter, and I was doing housing stories, I talked to that woman on the level she understood it. So she knew what a mortgage was. She worked for 3M in Minneapolis. Again, I made this up. But she didn't know what mortgage-backed securities were. So if I could talk about mortgages, but if I did mortgage-backed securities, I had to explain what they were because I knew she didn't know what they were. And so what happens is your reporting has a remarkable consistency to it because you're talking to the right person there. You have to be clear that that's the kind of people that are watching. When I became the stocks correspondent, I did the same thing. I invented a new person to have them talk to. And so it's very important to understand your audience and never talk above them or below them. If you use a phrase, don't use phrases that are au courant or current and assume they understand what you're talking about. Don't ever assume the audience knows what you're talking about. They have to have a certain level of complexity or an understanding just to watch CNBC, but you can't talk like a college professor. And my skill set was always that. If you think, Mark, about your career, what are you good at? What is your skill set? What are you really good at? Now, you might say, in my case, oh, well, you're an expert on the stock market. Well, yes, but that's not the skill set, actually. That's a knowledge base that I have. My skill set, since I was a child, was the ability to write well. I always could write well.
Which is really difficult for most people.
I was good at it from the very beginning. I was really good at research. I was naturally curious about the whole world. And this is the most important thing. That natural curiosity I had, that's what drove me into journalism. I just loved reading about everything, not just financial reporting. I was in physics at the time. I could talk about general relativity theory just as well as stock market theory, just as easily. So I really was a good writer. I was curious about the world. I knew how to do research. I knew how to talk to somebody. I wouldn't say I had interviewing skills. I learned that later, but I was curious about talking to people, and I listened to people. Those are the core. On top of that, I had one other skill set that really helped me out. I was really good on my feet. I knew how to talk in front of an audience. Even when I was 5 years old, sitting in the back of the class with my friend Charles Sachs doing fart jokes, the teacher would say, Bobby Pisani, what is so funny back there in the back of the room? Why don't you come up in front of the class and tell us exactly what's so funny? And I'd go into the front of the class and go all George Carlin on them. I knew how to make them laugh. And that's a skill set when you're a TV reporter that's really critical, which is why college professors have a hard time on TV. They know what they're talking about, but knowing what you're talking about is necessary but not sufficient when you're on TV. You have to have the verbal skills to translate that knowledge into shorter pieces of information, sound bites, if you will. And if you can do that, you can be successful. But if you can't, sometimes it's a struggle.
Well, so let me ask you that. So you were skilled at that. We just walked through that. You know, a lot of our folks, listening in here, financial professionals, financial advisors, are working with their clients, prospects on some very complex ideas. What advice do you have for them on how to get better in communicating, becoming an effective communicator? One, you mentioned careful on jargon. Don't assume people know what you're talking about. Anything else come to mind?
Look, the biggest mistake people make, for me as a journalist, is they try to do too much marketing. So, for example, I had an ETF show. It was one of the things that I was an expert in, I would say. And oftentimes this show was once a week, and oftentimes it was revolving around some new ETF concept or idea. So I would call up the issuer and say, bring me on somebody. Usually I knew who it was. And I always had to say, look, you're going to be successful at this if you explain to the audience why they might be interested in this product. That is different than you acting like the marketing department. You are a thought leader. You are not the marketing department. And when you get really good at this business, you can tell marketing people are trying to act like thought leaders. It doesn't quite work. There's a certain urgency to the way they're trying to sell it to you. Thought leaders say, so I'm interested in why we have this. What's problem are we solving here? And one of the things that I always liked is simple products. I like index ETF concepts. I love the S&P 500. I love the triple Qs. I love small cap value because you can explain these things. I love bonds and bond ladder funds. You can explain this to people. Part of the problem I've had with the ETF industry is the products have gotten increasingly complex, particularly in the active management space, to the point where it's really difficult. They're very niche-y now. I'm not saying people shouldn't use those products. I'm saying that if you want to be on TV and explain them, you better have a damn good story. And that gets to the second part. Besides trying to market too much, being good at explaining complex things. Now, I'm a journalist. That's my job. I just told you that one of my skill sets is I'm good at taking complicated stuff. I can explain general relativity just as well as I can explain stock indexing. So it's not the knowledge. It's the ability to translate. It's a higher level thing. It's ability to take complicated subjects and explain them. Beyond that, what you want to do is really just keep that audience in mind and find a way to explain your product in a simple way. Now, I've had people who can't do that, and what happens is it puts the burden on me. And oftentimes, I have gone on interviews with people where I'll put up full screens on the TV that will explain it. I will have already done it because I know they're not going to do it.
You know what's coming from them.
Yeah.
Or not coming.
I'll do an interview beforehand, and I'll determine they know how to do this, or I'm a little concerned this product is either too complicated or they can't do it right, and I'll put up a full screen. A full screen is a visual that explains what the product is that I will have written and explained it. So, but if you can do that, it's really helpful. So keeping your audience in mind, having the ability to explain things so that a broader audience can understand it, and not trying to market too much.
All right, you mentioned a couple of investment concepts there. I want to dive into that, and I want to go back to some quotes that I've heard you say. I'm going to read you a quote, and then I'm going to have you expand on this a little bit here. So here's the first quote. Don't trade your way out of a difficult situation.
Yeah, this goes back to the old story many, many years ago about overtrading. Many years ago, I met Jack Bogle, one of the most influential people here. I want to talk about Jack in a minute. But even in the early 1990s, we were very aware of the fact about I was advising people to trade too much. We knew that trading too much introduces mistakes. We knew that most active advisors underperform the market. We knew that the fundamental problem was to time markets, you must be right going in, and then you must be right going out. And almost nobody can do this. We already had data that indicated, everybody's favorite numbers is if you're not in the market on the 10 best days of the year, you have notably less returns. If you are in the market on the worst 10 days, you have worse returns. But nobody knows when those 10 days are. So one of the things that I did in the 1990s was I went to the best traders I could find. I mean, I spent a lot of money on barbells, asking them, so what's the secret here? Most of them were sell-side people. And most of them particularly said, be very careful about trading too much, and also about knowing when to cut your losses. There's a whole chapter in my book about this. But one fellow, quite famously, Buzzy Gould from Herzog Hein Gould, said, "Praying is for Sundays. It's not for Monday through Friday." So, knowing when to get out of a losing position is very, very important. The book has a chapter discussing some of these other things that I learned from big-time professional traders, but knowing when to cut your losses and avoid trading too much, two big things.
All right, I'm going to come back to your book in a minute. And one more quote I wanted to run by you and get your thoughts on. The stock market is a winner's game, but it's not a casino. And the irony of that, we're here in Vegas, having some fun. But expand on that a little bit.
People like to say the stock market is a casino, and this is idiocy. If you are betting on a daily basis, yes, there are casino-like elements to it. But long-term investing is the opposite of a casino. In a casino, the odds are with the house, mathematically designed to win for the house. That doesn't mean that you can't walk in and make a winning bet. You can. But if you keep playing, it is mathematically designed to lose. If it didn't, they would change the odds.
I proved that last night, by the way.
You're one of those.
Yep.
Okay. So it's very important to understand the difference. In stock investing, long-term, mathematically, you are a winner, but you must stay in the game. So understand the difference. In a casino, if you stay in the game, you are designed to lose. In the stock market, if you stay in the game and you're properly diversified, you are a winner. This is obvious to anybody, but people who like to say, people who are gamblers like to say, the stock market's a casino, just like going to the, and it's not. So it's idiocy to say that.
I love it. Walk us through how your views on investing have changed over time to where you got to that point that you just mentioned there. And then maybe that brings in a bit of your Bogle story too.
Yeah, I wrote this book, Shut Up and Keep Talking, and it's very instructive because it's a sort of quasi-memoir, a look back at what I learned over 35 years. So one of the things you do is you sit there and you say, well, what did I learn? I'm writing a book about what do I exactly know? And by the way, when did I find this out? So this actually happened. I have a yellow legal pad in front of me. I actually started with a yellow legal pad, and I said down, okay, what are my principles? What do I stand for? What do I think that I know about anything? So I ended up with a couple of pages of notes, and then I said, okay, I think this is right. When did I find this out? And I realized that the source of most of my beliefs go back to a series of people that I met in the 1990s. Charlie Ellis, a very famous academician who wrote Winning the Loser's Game. Burton Malkiel, professor at Princeton, who wrote Random Walk Down Wall Street. Jeremy Siegel at the University of Pennsylvania, who wrote Stocks for the Long Run. And most importantly, Jack Bogle, the founder of Vanguard. So when I became the stocks correspondent in 1997, I started looking at these books. Charlie Ellis had Winning the Loser's Game out. Malkiel had the Random Walk, and Jeremy had Stocks for the Long Run. They all had these books out. But Bogle was on the verge of being famous. He wasn't legendary in 97, but he was known. And he was not liked on Wall Street because Wall Street didn't like the idea of low-priced index funds. People were saying, who wants to bet on mediocrity? Like betting for the market
exactly.
is
It's
mediocrity.
un-American.
Un-American, that's a famous phrase. And it's all baloney. That's all baloney. It's all baloney and sour grapes by active managers who are angered that they couldn't get high fees anymore, and people realized that it was better for people to stay with low-cost index funds. Plus, you had the obvious advantages of ETFs with tax costs, lower taxes and things like that, and better liquidity. So I called Bogle when I transferred to being the stocks correspondent. I got him on the phone, to my surprise. This is 1997, and I said, hello, I'm Bob Pisani, I'm the stocks correspondent. I'd love to have a relationship with you. I'm a big fan of Vanguard. And he said to me, Mr. Pisani, thank you very much for calling. I'm very happy to have made your acquaintance, but I have to say I'm not very happy with your television station. Called it a television station, which is kind of a quaint anachronism. I said, well, what's that? And he said, well, Mr. Pisani, frankly, you have too many people on your show talking about day trading their way to riches and wealth. And it's not going to happen, Mr. Pisani. I don't hear what really matters. I don't hear about long-term investing. I don't hear about sound buy and hold principles. I don't hear you explaining why buy and hold is superior methodology to trying to trade your way to riches. Now you have this fellow on. You're trying to make superstars out of these people you think are big stock pickers. You've got this fellow on all the time, this Bill Miller fellow from Lake Mason. Now, I have no doubt that he's outperformed in the last few years. Nice fellow. But you know it's not going to last, Mr. Pisani. Do you understand that? I'm thinking, oh my God, I'm being interviewed now. I said, well, what do you mean by that? He said, well, you understand it's not going to last, Mr. Pisani. Now, I know you have this fellow, and you say he's got this great track record for 5 years or 7 years, and you have other people. Do you understand there's 10,000 fund managers out there? That you can find a half a dozen of them that are really outperforming over the last few years is statistically quite likely, even when you have a large enough sample group. Do you understand that, Mr. Pisani? I said, yes, I do. He said, okay, now let's talk about this record that these people have. You say they're amazing because they have a 5 or 7 year track record of outperformance. Do you know what the word persistence is, Mr. Pisani? And I said, well, I think it means it's not going to last. He said, well, yes, generally, that's exactly what it means. So let me tell you something, Mr. Pisani. The people that you keep citing, this Bill Miller fellow and all these other people, they may have outperformed in the last 5 years, but they're not going to be the people that outperform in the next 5 years. That's persistence. That's the lack of persistence. Do you understand this, Mr. Pisani? I said, God, if he keeps saying, do you understand this? I'm going to hang up. He said, yes, I do. He said, now, let me tell you what the implication of this is. The implication, Mr. Pisani, is that this skill set that you think they have is more a matter of luck than skill because there is no persistence. The people who outperform in the next 5 years are not going to be the same people who outperform in the prior. That implies that it's more luck than skill, even with these people you think have outperformed the market. Do you understand this, Mr. Pisani? I said, I do get your point. Good. So now listen. I've enjoyed our conversation. This was on for 45 minutes. I'm going to give you my personal phone number. I want you to call me when you feel like you have a question. However, I do hope that I'll see more long-term investing. I'm going to give you my assistant's name. His name was Gus Sauter. Wonderful fellow. Gus Sauter was the head of indexing at Vanguard and very instrumental. Turned out to be a very good friend of mine. I still know him. And so essentially that was 97. And I forget when Jack passed away. But for the next 18 years or so, I called him several times a year, sometimes once a month. Interestingly, I only met him twice. Because he came down to the NYSE, so it wasn't like we were buddies or pals, but I could get him directly on the phone, and he changed my life. That conversation changed my life. I called my wife that day, and I said, honey, this guy Bogle, he really does make sense. He's really right.
You know, at Dimensional, we talk about this idea of an aha moment about investing, where something just really clicks. Did you have that aha moment on the call?
Yes. When he said, do you understand, Bob? Mr. Pisani, he never called me Bob.
I loved how formal he was.
Oh, it was like a professor. It was congenial but instructive. Like, you don't understand, Bob. You let me explain how things are working. And I got to love that very kind of direct professorial style. But yeah, when he said, do you understand they're not going to be the same people that outperforms in the next 5 years? That was the aha moment. Like, that's when I realized, it doesn't work long term. So that's when I became a bit of an indexing guy. The next thing that happened that really changed when I met Robert Schiller in 2000. Schiller was a Yale professor, one of the founding fathers of behavioral economics. And he had a book out in March or April, just as the dot-com thing was happening, Irrational Exuberance. Yep. And it was sort of a summary and discussions of behavioral economics. But the point about Schiller was, in the 1980s, he had done research that indicated that the volatility of the stock market was far greater than would be expected if people were normal, rational actors and just bought and sold based on future expectations of earnings, which is what the stock market is. And he concluded that there was an irrational element to investing, is the only way to explain the excess volatility. And this was the birth of behavioral economics, essentially. This had a huge influence on me in the summer of 2000 because I came to conclude that he was right. People aren't rational economic. They don't buy low and sell high necessarily. They do the opposite. Why? Because there are certain irrational components to it. And the big things was that I got involved in was why the future is so unknowable. Why are people so terrible at making predictions on the stock market? And it turned out, Schiller's point was, number one, there are biases that literally infect us. Behavioral biases, confirmation bias, overconfidence that literally infect your brain and cause you to misjudge events. The second problem is just the sheer body of information that goes into determining a stock component. And what happens here is, I always say the example of a Caterpillar analyst. His job is to predict the Caterpillar price 1 year from now, it's December, and what's the earnings? See, it's just Caterpillar, how hard can it be? It turns out extremely hard because there are so many components to go into making up that stock price, including macro events like the global economy, competition the Caterpillar has, the health of the CEO, what's going on with Congress. It turns out there are literally tens of thousands of components that go into making up that stock price that makes it really different. So you throw the biases, the individual biases that people have with the massive database that you have to determine where these prices are going, and the fact that a lot of it is a black box because you don't know what the future is going to do, makes it really difficult. When I finally figured this out, it took years, including studying with Schiller, I got a lot more humble. I started paying much less attention to stock prognosticators, and we still report on that, of course, because people want to know. But I don't pay much attention to it anymore because I know it doesn't matter. This is what I learned by hanging out with Bogle and Charlie Ellis and Burton Malkiel and Jeremy Siegel. And when I finally realized that, I realized that by about 2000, my worldview had been set. I didn't realize this until I wrote the book because I didn't think about it. But that's kind of, I'm the same person I was 25 years ago philosophically.
Well, I started at Dimensional in 1998 and read those books you just mentioned there. And I would suggest to those listening, they're just as relevant today as they were
Absolutely.
back in the 90s.
I saw
Mr. Bogle's comments are just as relevant.
Yes, it is. And I had dinner with Jeremy Siegel, a dear friend of mine, lives in Philadelphia, when I was writing the book, because I was a little nervous, because I was sort of relying on this. This is still what I believe, but if you're a reporter, you have to ask yourself, is it still true? So I went with Jeremy. We had dinner. I said, Jeremy, listen, I'm writing a book. It's sort of a quasi-memoir. And I told him what was going on. I said, but you were a huge influence on me. And I'm citing some of your research. And there's a new edition of the book coming out. I just got to know, we're good on this, right? All the stuff, that I learned from you, it's not bullshit, right? It's all real. The research is indicated. He said, Bob, it's all good. Don't worry about it at all. So, and I met with Charlie Ellis, too. So I went to all my heroes. I went to have lunch with Burt Malkiel in Princeton. And I said, we're good, right? Okay, tell me if there's anything that's like really weird or bizarre.
Well, a lot of people will say, go back to your comment about people are irrational, because we're all just human beings, right, and have emotions. But some people will say, well, but because that irrationality, somebody has the ability to then take advantage of that and outperform the market. You just don't see evidence of somebody being able to do that consistently over time. So it goes back to those fundamentals you just described there. Absolutely. We are wrapping up here on our time. You are the headliner here to wrap up the day, so I can't wait to hear your
I'm
talk
very
you got
happy to
coming up
be here. I've been going to this conference for many years. The organizers are friends of mine. One of the things that's beautiful is I get very emotionally involved in this. This wasn't a job for me. This was my life. It was my whole career. And so I'm quasi-retired, but I'm still involved. I want to, I'm doing some lecturing. I'm doing emceeing, as a guy, as a personal person outside of CNBC, and it's a great way for me to keep staying involved. I'm going to talk a little bit about the past and tell some celebrity stories, but I'm going to spin it forward a little and talk about the ETF business today, what I like, and some things that I concern me a little bit.
Well, you mentioned you're getting around 70, and
I
a
am
lot of
70.
people slow down at that point. You're still cranking. You wrote your book, working hard. So here's what I'm going to do as we wrap up here. Are you ready for some rapid fire questions?
All right.
All right, here we go. What time did you have to wake up when you were doing your show?
5:15 a.m. And let me tell you, I don't miss it. It's one of the things people ask me, what do you miss? I miss the floor. I miss CNBC. I miss Carl Quintanilla and David Faber, dear friends of mine, other people there. I do not miss getting up at 5:15. And what you do to get through it is you lie to yourself. You say, oh, I'm a morning person. Not. I go to bed at 12 now. I get up at 8. And I make tea for my wife. And she's like, who are you? I make tea for my wife at 8 o'clock. And I sit in bed and I look at my email. But I had to be on the floor of the New York Stock Exchange at 7 a.m. Now it's 8:15, and I'm in my bed looking at my email rather than, that's a big difference.
Yeah, 5:15, your mind's going, right? Getting
And
prepped.
there's a big difference in getting 5 hours of sleep, which is what I got for 30 years, and 8, which is almost what I get now. And let me tell you, boy, it's startling. I don't drink 6 cups of coffee a day. I used to. Yeah, because you're on all the time.
Yeah.
You're potentially on the air because I'm not the guy who's on at 1 o'clock. I'm the stocks correspondent. I'm there all day. So in addition to any regular hits, if something happens that's weird, they'll call Bob, go on, talk.
You got to be ready to go. Very mentally taxing. For sure.
What happens is people ask me, "Do you ever get nervous?" I never get nervous, but what happens to you is you are in a constant state of mild agitation all the time. Because that's what it takes to just be able to do that. You have to keep like forcing adrenaline through your system to keep figuring out, okay, what do I have to say about this subject? Insight. You're paid to say something smart.
Yep. All right, question number 2. Who picked out your tie every day for the show?
Who what?
Who picked out your tie?
I picked out everything. CNBC had a wonderful series of contracts with different kinds of clothing suppliers, and it was wonderful to participate with that. But ultimately, there was a stylist who always had thoughts, but I was always a little more out there. I pushed it. Pocket squares, for example, one way you could express your individual. I was famous for the pocket squares, famous for slightly outre ties, a little more tie-dye-y, a little more psychedelic, a little brighter colors. You couldn't get too far out there, but it was one of the things I was very pleased about. One way you can express your individuality.
So you got some skills in fashion as well.
You learn things about what kind of lapels look like. How high the button stance is. You can use words like pick stitching. I'm very fancy. I can use those kinds of words.
Love it. Last one for you here, and this one may not be too fair because you're limited on time. A most embarrassing moment for you that you can tell publicly?
Well,
zipper down, hot mic, anything like that over the years?
No, the first time I was ever on the air at the New York Stock Exchange, is hard to describe what it was like in the 1990s. It was a fraternity party, and it was a wonderful fraternity. I can't tell you how wonderful it was, but it could be very difficult breaking into the fraternity. And when I got there in 1996, 1997, most of the guys on the floor, and it was all men essentially, 99%, were very suspicious of reporters. And they felt, why are you here? And, you could hurt me more than help me. And I had to sort of assure them that I wasn't going to be blurting out financially sensitive information. I was going to say, I just talked to John Smith over here, and he's got 100,000 shares of Pfizer for sale, because they don't want to hear that. They want to hear just general commentary on the markets. No specific talk about anything. And it was hard breaking into that club. So my first day and first hit, I'm a little nervous, actually, because it's my first time officially on the floor. It's 1997, and the head of communications at the New York Stock Exchange, Bob Zito, is a friend of mine. And the guys are watching on the side. So you're live, okay? This is it. If you say anything, it's live. There's no taking it back. So I'm ready to go on the air. The camera's above me, and Bill Griffith, my colleague, is the anchor, says, and now let's go down on the floor. Bob Pisani on the floor of the New York Stock Exchange. Bob, and literally as he's saying, Bob Zito hands me a note. And on the note, it says, "Your fly is down!" exclamation. And I hear Bill Griffith say, let's go down on the floor, Bob Pisani, and I'm looking, your fly is down. And I'm thinking, oh, shit. And so, P.S., my fly was not down. But that was their way of saying, welcome to the New York Stock Exchange.
That was the Ricky.
And I still have the note that he gave me. And I start talking. Thank God I didn't look down, start staring at my fly. I keep talking. It's like, shut up and keep talking, keep talking. And they're all cracking up from the sidelines as their way of saying, welcome to the NYSE, Bob. I never had my fly actually down. I did fall in the water once on a test I was doing on waterfront real estate. I was walking on the pier, and I slipped. My foot caught on dock, and I fell into the water while I was walking and talking. It wasn't live, but it was a kind of funny moment at the time. But no, the amazing thing is, if you're on the air long enough, something silly will happen. And in my case, in the worst case scenarios, occasionally you'll make a mistake, like you'll say 32 instead of 23. You transpose a number or something like that, and that's kind of an easy mistake. You just correct it the next kind of hit. But Boy, considering 35 years on the floor, it was just an amazing run. Just amazing.
Well, congratulations on
Thanks,
an
Mark.
incredible experience there and bringing a lot of knowledge and wisdom. And I'll go back to education for millions of investors that are watching this every day. So job well done. And I could talk to you about, I'm sure you got hundreds of thousands of other stories as well. And we'll save them for tonight. Go have an awesome talk tonight as well.
Looking forward to it. Thanks, Mark.
Thank you
Thanks
very
for
much.
having me.
And thanks to all of you for joining The Informed Investor. Go get the book, shut up and keep talking, and have a fantastic rest of the day. Take care, everybody.